Vietnam's currency, the Dong, has always been one of Asia's most unusual currencies. The Dong's value is known for being very, very low. You see, $1 is the equivalent of over 24,000 Vietnamese Dong. To emphasize, $100 is over 2.4 million Vietnamese Dong. That is incredibly low, especially compared to neighboring countries. $1 is just 55 Philippine peso, or 4.6 Malaysian ringgit, or 35 Thai bahts. Such devaluation can imply that Vietnam's national currency is insanely low. Does this imply that they have one of the world's weakest currencies? Can Americans immediately become Vietnamese millionaires overnight? Well, unfortunately, it's not as simple as that. One's currency isn't merely about the numbers of zeros in there, but it does play a role. To grasp the entire concept of Vietnam's currency, it is important to have a look at its history. The currency was first introduced by the North Vietnam government, then known as the Viet Minh, in 1946, replacing the French Indochinese piastre. It underwent revaluation in 1951 and 1959. The South Vietnam currency, also dominated by piastre notes, was replaced by Dong in 1953. The capture of Saigon in 1975 led to the introduction of the Liberation Dong in South Vietnam, equivalent to 500 old Dongs. In 1978, following the unification of Vietnam, a new unified Dong was introduced, with one new Dong equivalent to 0.8 Southern Dong or one Northern Dong. This was a critical moment in the history of the Vietnamese currency, as it began a period of inflation that lasted through most of the early 1990s. The Dong was revalued again on September 14, 1985, with one new Dong valued at 10 old VND. This revaluation led to an economic crisis characterized by heavy inflation, peaking at 774.7% in 1986 and the wiping out of people's savings. Prices for agricultural products, for instance, increased by 2,000% in 1986 compared to 10 years prior. This was exacerbated by government policies that banned all forms of non-state-owned internal trade. When the Asian financial crisis hit, the Vietnamese Dong was further impacted. The Asian financial crisis, which began in 1997, was a period of financial crisis that gripped much of Asia, including Thailand, South Korea, Malaysia, Indonesia, Singapore, and the Philippines. The crisis started in Thailand with the financial collapse of the Thai baht due to the decision of the Thai government to float the baht, cutting its peg to the US dollar after exhaustive efforts to support it in the face of a severe financial overextension that was, in part, real estate-driven. This crisis had a domino effect on other Asian economies. It led to a large drop in currencies, stock markets, and other asset prices of several Asian countries. The Vietnamese Dong, already weakened by its own historical struggles, was not spared. Vietnam's currency depreciated further as investors pulled out capital and the market lost confidence in the Asian economies. This event underscored the vulnerability of Vietnam's currency to regional economic shifts. Fast forward to today, Vietnam's Dong still continues to struggle. In 2014, $1 was about 21,000 Vietnamese Dong. Throughout the coming years, it would continue to go up to 22,000, 23,000, and then today at 24,000. The recent increase against the US dollar is attributed to the increase in Federal Reserve interest rates. However, before we go there, it is important to first discuss these devaluations. Indeed, we have talked about the many factors in history that devalued Vietnam's currency. It is due to many things, but to simplify them for this video, there are actually just a few major factors that you can know today that is determining the entire valuation. The first is due to Vietnam's economic structure and market dynamics. As a developing country, Vietnam has historically had a large trade deficit where it imports more than it exports. This deficit often leads to a depreciation of a country's currency because it indicates a higher demand for foreign currencies to pay for imports compared to the demand for the local currency by foreign traders. Additionally, Vietnam's economy relies heavily on foreign direct investment and exports, particularly in manufacturing and agriculture. Fluctuations in these sectors can significantly impact the Dong's value. Another major factor is inflation. High inflation rates can diminish the purchasing power of a currency, leading to depreciation. Vietnam has experienced periods of high inflation, particularly during the times of economic instability mentioned earlier. So when inflation is high, it typically results in a loss of confidence in the currency, both domestically and internationally, causing its value to drop. Monetary policy set by the State Bank of Vietnam also plays a crucial role. The central bank's decisions on interest rates, money supply, and other financial tools can influence the dong's value. For instance, if the central bank decides to increase the money supply, it can lead to inflation, which, as discussed, can devalue the currency. This is where we can discuss the Federal Reserve. The Federal Reserve, which is the central bank of the United States, has been steadily increasing interest rates to combat inflation. This, in turn, makes assets in the U.S. more attractive. When they are attractive, investors come in droves and drive the US dollar upwards. The Vietnamese Dong, on the other hand, will fall against the US dollar. To combat this, the Central Bank of Vietnam, which is Vietnam's state bank, may do several instruments such as increasing interest rates as well. This is what we saw recently when Vietnam's interest rate rose from 4% to 6%, but eventually fell back to 4.5%. The narrative behind this is both to cushion inflation rate and also help ensure the US dollar isn't too strong against their own currency. But it is important to understand that a too high interest rate can slow down an economy due to high borrowing cost. Now, let us move to the final part of this video and understand the advantages and disadvantages of having a weak currency like Vietnam. On the one hand, a weaker currency can be beneficial for exports. It makes Vietnamese goods cheaper and more competitive in the global market. This can be particularly advantageous for a country like Vietnam, which is heavily reliant on exports, especially in sectors like textiles, footwear, and electronics. A lower currency value can help boost export volumes, leading to higher production and potentially more employment opportunities in these sectors. On top of that, a weaker dong can attract more foreign tourists and investors. For tourists, a lower currency value means that their foreign currency will buy more in Vietnam, making it a more attractive destination. For investors, particularly those looking to invest in manufacturing or real estate, a weaker currency can mean lower costs of investment and operation. But the disadvantages of a weak currency cannot be ignored. The most immediate impact is on import costs. A weaker dong means that the cost of imported goods, which can include essential items like machinery, raw materials, and even consumer goods, becomes more expensive. This can lead to inflationary pressures as the cost of goods and services increases. Moreover, for a country that relies on imports for many of its basic needs, a depreciating currency can lead to a higher cost of living, as consumers have to pay more for imported goods. This can be especially hard on lower-income groups and can widen economic inequalities. In addition, a consistently weak currency can undermine investor confidence. If investors believe that the currency will continue to lose value, they may be hesitant to invest, particularly in long-term projects. This can limit foreign direct investment, which is crucial for Vietnam's economic growth. And finally, it's important to understand that the value of a currency is just one factor in a country's overall economic health. While a weak currency can offer some advantages, it's essential to balance these with policies that promote sustainable economic growth, control inflation, and encourage domestic investment and consumption. For Vietnam, managing its currency while developing its economy in a balanced way remains a key challenge. But anyway, do let us know what you think. Thanks for watching.